Good morning. This is Jeff Pomerance, head of Transactional Practice at SulmeyerKupetz, and our presentation this morning is on Private Equity Investing 2018, Working Investments to Build Value. I want to start first and foremost by welcoming our listeners, our attendees. Thank you very, very much for joining us today. I also want to start by thanking Megan Braverman and Burbe, who helped coordinate this, and they do a fantastic job, and we're grateful for their help. I also want to introduce my co-host in this. He is believe it or not, a former client and a very good friend. I have to offer one mea culpa as I commence this, and that is one of the messages we are going to convey is it's not always best to think that you can outsmart the room. I must confess that I brought someone here today who I've always thought, in the deals I've worked on and things I've done, can outsmart the room. His name is David McCarthy. David, good morning.
Thank you. You're too kind, and we'll have to settle up on this later.
Yeah. Okay. Anyway, David and I put this together based on years and years of doing deals on every side and facet, as attorneys, as investors, entrepreneurs, financiers, and we are excited to share with you some things that we've seen over the years that perhaps don't jump out and aren't readily available or apparent. We have attached or included in our deck today our backgrounds, mine and David's, and certainly we're comfortable and confident in discussing this, having dealt with it for many, many, many years. Let me begin with the overview of what we're trying to accomplish and our goals for today. 2017 was a great year for the private equity market. Notwithstanding the last couple of days, 2018 appears to be very promising. Private equity investors are feeling ever-increasing challenges to reaching these targeted goals, and that's pretty much what we've heard and seen and what we want to discuss today. As we'll discuss, there are with a number of eyes on deals and market multiples rising dramatically, it's going to be very difficult to generate the targeted returns. And as I alluded to initially, it's probably naive to believe you can simply outsmart or invest smarter, finding values that others don't see. What then should private equity investors do in today's current investment climate to build value and continue to enjoy sustained growth? Well, we've listed three goals here. Recognize the present state of affairs in private equity investing, which we'll touch on. Rethink the private equity investment model. And number three, suggest concrete steps to building value in private equity investments. Now, I hear this quite often, and that is, if it's not broken, don't fix it. And I believe that one of the themes of our presentation today is, if you fix it, it won't be broken. Let me briefly go through an outline of our presentation just so you know where we're going with this. Number one, we're going to talk about what you will not hear from us. Then we'll discuss, really today's focus, what is private equity and middle market. We want to make sure that we clarify what market and what we're discussing so that we can then build in some insights into what we've seen and how we think that changes can be made to be helpful. Then we're going to discuss the present state of the private equity investment. We're going to then go on to an examination of the process of doing a deal, continue with the evolution on a structural basis, really, of the private equity industry, rethinking the private equity investment model through activism, and developing strategies to build value. So with that, let's begin. What you're going to not hear today. You're not going to hear simple solutions. Too often, people have come to me and said, I just need a quick answer. Is there a form? Is there something, that I can easily do? That's not if there's something like that exists, I don't know about it, and I'm pretty confident that it doesn't exist. There are no simple solutions. Second thing you're not going to hear is investment tips in specific sectors or industries. I'm sure all of you pick up the paper and read and see whether it's technologies, whether it's retail, whether it's, it could be any healthcare. We're not going to get into specific sectors or industries. Our discussion today is really agnostic as to both sector and industry application. We're not going to guarantee outcomes. One of the reasons why we're going to talk about private equity is so there's such an interest in it is because the returns have been fantastic. And with returns, there are risks. So part of this process is discussing how to address those risks to manage the risk-return relationship. Lastly, you're not going to hear specific deal structure and recommendations, as these are really fact-sensitive. Okay, let's first clarify what we're talking about. Private equity, in the broadest terms, is really the discussion of funds raised to directly invest in private companies, which are generally raised from institutional and credit investors. Typically, these funds are structured as closed-end investment vehicles with set holding periods and are subject to management and performance fees. Now, David, maybe you want to just clarify, sometimes there's a misunderstanding between venture capital and private equity.
Well, yeah, it's a very different thing and a different model. Of course, the venture market is associated with early stage institutions, companies that are in their formative stage, and where the issues are how to create growth and build the fundamental foundations of companies, and it's a much more high risk proposition, as opposed to the private equity market, which has always set itself up as being really different in addressing existing companies, either to finance them to greater growth, perhaps buy businesses out of corporations, but to provide an alternative capital source for businesses that are more mature with different sets of problems. And increasingly, one of the facets of that, which I don't think we'll get into today, though, is there's a lot of trading from one firm onto another. That the model of private equity, to some extent, is we're developing a company and growing it to sell to another private equity company.
Right. That's
but they're very different businesses.
Which ties in, thank you, David, which ties into the next point that I just want to clarify, and that's defining the relative investment markets. I've listed in the PowerPoint presentation 3 categories. We call them the unicorns, or denoting a venture cap based company valued at $1 billion or more. There's approximately 1% of the total number of completed venture capital transactions in 2017 that are considered unicorns, yet they represent 21% of the deal values. The market, this market is presently estimated at about 176 U.S.-based private companies. Contrast that with the middle market. Relative size, deal values generally top out at about $1 billion. The characteristics in this market, there tends to be to offer more companies to invest in. There are greater opportunities to change companies, and in terms of your investment, and there are lower valuations and barriers to entry than the larger deal investment market. And within that, we also want to break down that middle market, the lower middle market. Again, the relative size here, the deals are valued at between $10 million and $250 million. This market, a characteristic is that there are increased opportunities within the middle market. In other words, there are 350,000 companies with annual revenues between $5 and $100 million, compared with 25,000 companies with annual revenues between $100 million and $500 million.
And it's worth noting that what you hear about and see in the press is overwhelmingly focused on the large end of the market. And that's really great for a few large investors who are dealing with those kinds of companies. But the fact of the matter is, the bulk of the activity by transactions and investments is happening in much smaller companies. And what we're going to be talking today is going to be focused more toward that lower end of the middle market, which is where an awful lot of the activity is going on, and where an awful lot of activity is and money is moving.
Absolutely. But to clarify, on our discussion today is really applicable to all three, although our focus will probably yield more benefit to those companies in the lower middle market. Anyway, the next point we want to address is, let's examine the present state of the private equity investment industry. Is this the golden age of private equity? Now, I know that David had advised me that the market has not acted like it has the last couple of days, but that notwithstanding, I think that most people will agree that there are strong macroeconomic indicators. The U.S. economy is expected to continue to grow steadily, anywhere from 2.2 to 2.5% in 2018. There is relatively low, from a historic perspective, interest rates, and the tax reform that was enacted at the end of 2017, most experts believe that it's going to add a significant amount of additional liquidity, which is going to find its way into this private equity market. What we've seen is that there have been strong deal activity and buyout exit values, which are expected to continue. The private equity transactions are expected to continue really at a robust pace. Many of the people we speak with liken this to really a true seller's market. Buyout values and exit values that are expected, that have been fantastic, are expected to increase consistent with 2017. We note there was an estimated 24.5% increase in buyout value compared to the previous period in 2016, comparing 2017 and 2016. And our experience, what we're hearing, and our clients, we're really hearing that loud and clear, that it's really a seller's market, and buyout values, exit values are expected to increase in 2018. This, in turn, has led to a very strong fundraising environment. Private equity fundraising is expected to hit a new record of $750 billion, reflecting a projected increase from the record $621 billion raised for private equity funds in 2017. And what's notable about this is that the study, we noted 95% of respondents are satisfied or highly satisfied with the performance of their private equity investments. And we hear that from our clients. People are happy with their returns and are excited that they're able to gain new funding for their ventures based on what they've done to date. Also to be noted, there's a proliferation of players. We're dealing with a significant expansion in family offices and alternative financings. And we've seen, in fact, a number of new spin-offs from maturing PE funds, private equity investors that have been working for more mature funds that now want to break off and continue in the market on their own fund. And
even the phenomenon of search funds, where people are funding people to go out and look for businesses.
Right. No, that's an excellent point. And also another point to note that we note here is the proliferation of perceived support funds. We're seeing a significant rise in both restructuring financing and leverage financing. And what that has done is created a perceived safety net for more aggressive investing. In other words, if you are making an investment and you think that it may be a little bit more risky than you might prefer, you know that you have avenues to help you if things don't go exactly the way you want. Okay. Well, indeed, it may be a golden age for PE. And the question we want to explore is what's lurking behind the scenes. And to do this, we want to discuss three aspects. We want to examine returns on investment, the deal process, and possible compromises and implications of those compromises, and a discussion we refer to as passive investing and the breakdowns that can occur. And David, why don't you jump in and discuss what you're seeing in terms of returns on investment?
Great. Well, I think it's important to look at that because, as Jeff said, a lot of people have raised a lot of money. There have been entrants follow-on funds and big activity. And so, the question you've got to ask yourself is, gee, can you expect things to continue in the world that we've had in the past? And so one of the things I like to do is look at results and say, how did we generate the returns we've got? And the answer is, it's not straightforward. And the first thing I would say is, let's look at the question of, with these buyouts that have been so successful in the last year and generating great returns for funds, what's behind those numbers? Well, the first question I ask myself is have these companies been successful in hitting the margin targets that you thought they were going to hit when you invested in them, anywhere from 2 to 6, 7 years ago? Did they achieve what you expected? And the sad answer here is when and by the way, the slides here, I'm looking at some stuff in the Bain report at the end of 2007. I pulled these numbers out. There are lots of different studies. But if you look at the firms as to whether or not they achieved the margin that they expected when the deal was done, 2/3 of them didn't get there. They missed the expectations that you as a private equity investor had when you made that investment. The next thing I'd want to think about is, well, what kinds of returns did we get on the capital we deployed? And in this case, same source. Let's compare how many of the investments had a return of a write-off, making 1 times what we invested, or a multiple of what they call the MOIC, the multiple of invested capital. And the sad thing here, and the truth of this, and by the way, lots of private equity funds, and most people will tell you, once in a while we have a problem, but by count, most of our investments are successful. Well, the fact of the matter is, 35% of those companies returned less than 1 times their investment. In other words, 35% of the companies, you didn't even get your bait back. And you can look at the ones that are in the top quartile, but they don't do that better. So the fact of the matter is, one of the things that's always a part of this business that I don't think people fully really admit to is that while we have a few investments that do quite well, the lion's share of the investments don't do that well, and many don't return at all. So as I think about what's likely to happen in the future for what I face and what I've got to do about it, then I've got to ask myself, well, how did we get these great returns? Well, the answer is a simple one, and everybody knows it and everybody talks about it, but I'm not sure they've fully internalized what it means going forward, and that is that we've been bailed out by a multiple return. Again, if you look at the improvement in your investment of a return on your investment capital, where you want to have a number that's over 1, the fact of the matter is we're below the line on revenue growth. We're below the line on not hitting the margins we expected, and we had a great big benefit from the fact that there's been an enormous expansion in purchase enterprise multiples. That's a multiple of both debt and equity, and we're applying more leverage, which helps equity returns. That's another part of the story. And I mean, Jeff, we can remember back, if you go back to the early 2000s, most of the studies now you see start about 2006, 7. The multiples were 4, 5, 6. They crept up higher into the 6 level around 2005 and have steadily come up. In fact, if you just look at the period since 2007, we see this systemic, growth after 2008 from a level of 7, 8 up to north of 10. Well, if you carried back farther, it's a lot lower. The point is, multiples, and I thought about creating an exhibit to deal with this, but the impact of that multiple increase on returns is just extraordinary and has carried the day when, in fact, we really weren't getting it done on growing revenues and improving the performance of these companies. And not surprisingly, the response to that has been lots of money flowing into the industry where, and Jeff mentioned it, and in this case, this stops in 16, 17. I think it was another 13% increase in the money that came into the market. So money is flooding into this market, chasing what are attractive returns. Uncertainty about the stock market, certainly that the public equity markets, people have trouble, despite what's going on now. Good economic conditions can still be an argument for growth in public equities. But one thing that's sure is it doesn't necessarily look like a great opportunity. It's had its run, and if we're one to look at private equity, you could say, gee, there's room to grow. But the fact of the matter is there is so much money, and multiples have come up that we're really facing a different situation. So, the real question we've got to get into is, what do we do now? Where are we, and what does it mean? Well, we've got funds that have raised money at high levels, boatloads of investable cash, pressure to invest. It's funny, I was talking to a friend of mine the other day. Call him Sam. We've worked together for years. A lot of it's been in the distress area, but when we're not working together, he's an advisor to a large private equity fund, a name, you may not know the firm, but you would all know the name. And he works on their troubled situations, and he always scrubs down companies that they look at. He was telling me about a conversation the other day that he had where he was called by the operations partner, the guy who really worries about the success of the portfolio companies and comes in and helps and deals problem, and in fact gets Sam involved a lot to help when there are problems. And he said, hey, Sam, what do you think about this deal we're looking at? You said that, you thought we should go ahead and do it. What do you really think? Sam says, you really want to know what I think? Okay, run. Don't do it. Okay, he says to the other guy, Sam says, hey, Fred, well, what do you think? I agree. Sam's response, and this is tens of millions of dollars of equity investment. What are you going to do? Oh, we're going to make the investment. Why? Because we got money and we've got to put it to work. And I'm telling the story not to say that everybody does this all of the time, but there is more of that pressure that is created out there through the presence of tremendous multiples, a supply of credit, and low rates, which has driven a lot of activity. And by the way, keep in mind what we're talking about here is not just the problem of what we're investing in today. We've been talking about investing. As we get into it, there's a lot more to what you do after you invest. But let's remember that with a hold period of several years, we're talking about investments that you've made over the last 2 or 3 years that you're going to expect to have liquidity events on in the future. It's not just today's investments, but it's the investments we've made in the last few years. And these pressures of things that have happened as multiples have come up and liquidity and low rates have been available, that we've been investing assuming a model is going to continue, and it can be a challenge. So the issues may not look that good, which means, what do you need to recognize? A few things. One, there are lots of eyes on deals. When certainly people will complain in the private equity side that every deal they're looking at is highly competitive, and whenever you show up, you can bet there are lots of other people who are looking at the situation. The high price multiples, as Jeff said, people think those are going to continue, and one of the things that's led to, by the way, is sort of a down market creep and a herd momentum. Everybody now has a distress focus or is coming down to the lower market. There's always been a lower price multiple at the lower you go in the lower end of the middle market, the lower the price multiples are. And clearly what's happening is there's pressure of cash and pressure of investment that larger funds and activity are being forced to come down into the lower market for better pricing opportunities. That's been driving price up. And driving people also to say they want to move toward companies with more hair, companies that are in distress. And let me tell you, that's a different business, and people are starting to step into that without having experience. But the bottom line on all this means is it becomes difficult to generate target returns. When you One of the things I want to point out is, and this is, I think, an important thing to get people to focus their attention on is, I want to think about where we're headed. It's the same way I think about the public equity markets. There's always a distribution of outcomes. Things can get good, things can get better. And it's really instructive to sort of think about where you are and what could happen and what it means about whether or not you're facing a great environment or a difficult environment. And things I look at is, what's happening with economic conditions? Well, the fact of the matter is, things have been great. We've gone through arguably a 9-year economic growth cycle. Nothing goes on forever. And at some point, things in the next few years, maybe not this year, maybe we'll continue to run, but things could turn. Probably will, in my view. Will interest rates increase? Well, the Fed's been talking about it for a long time, and my sense is they're finally getting around to doing it, and there's a reasonable chance that we're going to see rates at higher levels. Unlikely, very unlikely, that it's going to get any better and we're going to see lower rates. There's also an issue if you're an investor, again, with investments you're making today or ones that you made a year ago. Are we going to have access to liquidity? And what I mean is access to liquidity for the next investor who is going to take you out. People have different models. There are those who have long-term investment horizons of 3 to 5 years. There's some people who invest flippers who think they're going to turn something in 1 to 2 years, betting on market conditions or maybe making a change in the business. But whatever their horizon, they're betting on a takeout. And you've got to ask yourself whether or not that's going to be there. And then finally, and this is the one that is really troubling, and that is the possibility of multiple compression. As we say, we've had these multiples going up for some time, and the question is, if you make a purchase multiple price of 10 and the market multiple is 8, when you sell that business, you have to have improved that business 20% to get out of the hole to stand even. And the fact of the matter is, seems to me like we've been sitting in high cotton for some time now. And the real question is it moving here? Or is it even possibly moving here? I don't really know, but I do know it's probably going to shift somewhat to the left.
David, thank you. I want to now touch on a couple things that need to be factored in this analysis, and that is a discussion of what I call the deal process, and specifically what's happening in the deal process. One of the things that companies that seek assistance look for from their advisors is help in securing the process that maximizes the chance of success. There's no magic formula, and so one of the keys in terms of maximizing the probability of success is to focus on a process that's designed to achieve success. So I want to begin by at least spelling out a little bit of what we call the deal process and break into 4 components. First, source generation. This can relate to a private equity fund raising money. It could also relate to a private equity fund finding targets in which to invest. The second aspect is the due diligence. Once you've found that target and once you have powder, the next thing is to study the company, see what its core values are, what the opportunities are, the risk exposure, and then decide whether you want to move forward. Assuming you want to move forward, the next part of the process is the beginning of the negotiation, drafting of documents. And often this is through a letter of intent or a term sheet. And obviously this is a means of taking the information that you have and crafting a deal that works, and then memorializing that deal in the documentation. And lastly, if everything goes well and the documents are drafted, the negotiation has led to a successful outcome, closing occurs, signatures, funding, and now a private equity fund has a new portfolio company, and then it's the process of integration. So along these lines, in the deal process, one of the things that I think is important to address is how important each one of these steps are to the process itself. And what I mean by that is, so often I've seen that breakdowns have occurred in the deal process through some breakdown in one of these steps. I'll give you a couple examples. An investor, a private equity fund, has a major investor that wants the fund to invest in its company. It may compromise in this person's company. It may compromise the due diligence. It may compromise the examination of whether that company really fits within the private equity fund's kind of bailiwick of expertise. We see too often, because David had mentioned this, because there's this tremendous pressure to do deals and to move money, to invest money, that there is a compression often on the due diligence side. We've seen that. I've seen that in my work with companies that said, look, we've got to get our due diligence done within this amount of time, because if we're going to make an offer, we got to make an offer by this approach. And that compromise in due diligence, as we're going to address further, can really and significantly affect the value proposition that you're seeking to attain. One of the critical areas which we're also going to address is the negotiation phase and the concept of active versus passive investing. And lastly, what we've seen often is once the deal's done, the closing's occurred, and you've already established that you are aligned with management, and everything's beautiful, the wedding has just occurred, we are on the honeymoon. The question is, have you, as a private equity investor, have you looked at the integration associated with that investment? And one of the things that we want to drill down on a little bit further, and it's found throughout this, is the concept of passive investing. David, why don't you jump into a little bit about what we refer to as passive investing and the breakdowns that we've seen?
Yeah, I think this is important. And again, the audience I'm speaking to here is the private equity investors, and these are things that I see where, as we think about trying to generate these returns, where we tie our hands in ways that make us less successful. And the first one I would talk about is the issue of promises made. And there's a fundamental contract that goes on between the private equity fund or even the venture fund. Well, not so much the venture fund, but private equity folks and companies that they invest in, that they're not going to interfere. Involved with a company that's going to market for a liquidity or sale event. And so I've interviewed tons of private equity firms, and they all come in with the same story. Hey, we're not going to get in your way. We're going to let you do what you need to do. We're not here to run your business. And that's a fundamental mistake. And we'll talk about later why you need to get involved. But out of the chute, they say, we're not going to get involved. They also say, we invest in great management teams. It's a mantra, sort of a philosophical belief that you only invest in good management teams. And the fact of the matter is, every management team can do better. And you need to recognize that part of your job as an investor is to find out where and how you can make that team better. And by the way, if you can't make it better, you've probably overpaid anyway, given these multiples that are there and the competitive nature. So that, and I've never seen a company that doesn't need help. And by the way, the smaller they go, the more that's true. So as you tend to move more down market into smaller companies, you have to have the expectation that you've got to get involved. The second thing is an absence of operational awareness. And my pet peeve is the usefulness of board packages. You may sit on boards. I'm involved in boards. Either an advisor or a board member. And my complaint is that what you usually get at a meeting is a validation of the plan and how people are on target and how they ought to get compensated, or how people are fixing a problem. Very rarely is there an investment in saying, these are the new things we need to work on to make it better. They tend to be focused on getting you to accept that things are on track, and if everything's okay, we leave it alone. And for that reason, the next thing is they don't tend to get into the real business metrics that are driving results. They explain the results, but always at a top-line level, or at least not as deep as they can go to cause you to probe into the business and drive to why one part of the business is not doing as well as the other. The fact of the matter is the data is there, and you need to be able to get into that. You need to get into the weeds. I sit on one board where the chairman frequently says, we don't want to get down into the weeds in this issue in the board meeting, and I will keep quiet. I call the CEO back after the board meeting, and I get in the weeds with him because I want to understand, and I want to help him understand what he can do to make his business better. But there's a bit of a standoffishness that people engage in, and then the final thing is letting it drift too long. Nobody takes action too quickly. Generally, things are let to go a quarter or two before action is taken. By that time, solutions are imperfect or whatever are being hardened, and you miss the opportunity to fix things.
David, interestingly, David and I yesterday were on a call with an opportunity for a company in Los Angeles, and the reality is they have such a short runway. That the ideas that we talked about in terms of helping them, which might have worked 4 months ago,
they may have run out the clock.
They may have run out the clock.
They may have run out the clock.
We see that, unfortunately, too often.
One of the other challenges is a lack of operational skills. If you look at I look at private equity firms all the time because I get involved in them. The first thing I do is look at who the people are. And when you look at them, what you see is a pattern where 50% of the partners typically have never had any operating experience. A lot of lawyers, a lot of finance guys, not many business people who have built or run a business.
David, let me interject. I was involved in an incubator, and we had a number of portfolio companies. And one of our major investors, a fund out of Silicon Valley, would ask us to populate our subsidiaries with recently minted, it's David's alma mater, Stanford, with MBAs. And it's wonderful to have bright young minds in the room, but these type of companies, early stage companies, startups, the key metric of performance, of existence, is cash. And so we're sitting in a room, a board meeting, and I listen intently to hear that the board member asks for what are the matrices of development. At that point, I believe I said, can I ask one question? And the person said yes. I said, have you ever made a payroll? The person said no. I said, I love your input, but matrices of development tell me that you don't understand even the fundamental aspect of this business. And so what I've seen as an attorney and in the finance world is having a strong finance background is tremendous and wonderful. And the MBA programs do a great job. Certainly necessary, but not sufficient, though, for really helping the companies that need help.
I think that's right. And by the way, the power of the analyst ninja who has come into the industry is fantastic. And the level of sophistication is great. But there's no substitute for having had at-bats. Right. And that's a real issue. And the opposite thing is true with industry gurus. There's a tendency sometimes to bring in industry gurus because they know a market or they have some experience. Part of the challenge is they may be fighting the last war, not the current war. And sometimes you get people who have great prior experience, but they may or may not be good at creative problem solving and getting answers quick. So the point is there's a dearth of operational skills that these funds have, And the last thing is, and this is the killer, and that is that it's not my job, I don't have time. I talked about the fact of talking about the board chairman saying, let's not get down in the weeds. Oftentimes boards of private equity companies will take a view, and then the boards are the private equity funds. I mean, the boards of portfolio companies, rather. It's the private equity folks. They'll say, look, our job is to hire the CEO to set strategic priorities, to make strategic decisions, but we're not going to tell you how to run your business. Well, I think that's a mistake. And again, I think a lot of the CEOs need help, and your job is not to just be strategic and to set policy and make decisions. Your job is to come in and help. And the problem is that's a bursty problem that can take a lot of time quickly to respond to a problem. If you don't tackle certain problems right away, it can be quite problematic, and it's hard to fit that in with the structure of the private equity model as you envision it as a partner of private equity fund. But the fact of the matter is, you do need to be able to drop everything and engage with the portfolio company. It's a mistake if you don't do it and you don't let it go. And it's a very tough thing to do. And when you do it, you've got to realize you've got to take the time to run all the traps on it.
Thank you, David. One of the things then to explore, we've talked about where the PE industry is and some of the issues that we've seen. We're not alone. And the industry itself, private equity, has recognized, and we are seeing structural changes, the evolution of private equity. We've listed a number of them here. Most notably, PE firms are specializing in sectors to compete, and they're finding success in doing that. You're seeing middle market funds broaden their focus to include, or non-middle market looking to middle market, and middle market looking to smaller middle market. You're seeing firms doing deals without a dedicated private equity fund or through non-traditional methods. You're seeing PE firms selling minority interests, making co-investments. Recently, I saw a fund that their new round going out, instead of 10 years, now they're going to 15 years. So private equity is recognizing that even though things have been excellent and hope to continue, that change is inevitable and necessary. But these are structural changes. And where we really want to kind of bring this forward is rethinking the private equity investment model. The concept, and it sounds so simple, but perhaps it needs to be stated, and that is active investors need to actively invest. David, why don't you jump in and talk about the concept of activism?
Well, first off, remember from what we said up front and what's happened with market conditions is you can't expect to make it on the front end. What do I mean by that? Well, these competitive multiples, as we said, are constructively putting you in a return hole. And there are things that you're doing in your traditional model which may not be helping you maximize value. You're reducing your ability to take action. Leverage game's up, and it's pretty hard to count on the fact that you can be smarter than other folks, right? And again, this applies not just to deals you do now, but deals that you've done in the past. So the fact of the matter is, you've really got to make it on the back end. This isn't about investing. It's about managing investments. It's not about thinking you can get it all done day one and have the presence of time and the pay down of debt to take you out of things. So what have you got to do? You have to work the deal. You've got to work the deal actively. Second point is you have to make it better. That's not, despite what people say, that is not necessarily the operative model of private equity funds to really try and improve results. There's a plan that the selling company made when you did the investment that was to improve results. But you paid for all that in the multiple that you spent up front. The question is, you got to figure out how to improve results above that. And the third thing is, you have to relentlessly move to cut off problems immediately. And then, by the way, structurally, one of the things I think is important to note with what Jeff said is that oftentimes you're there with a co-investor. If you're going to be an activist investor in this model, you've got to understand and make sure that your investment partner, is aligned with you with the same kind of philosophy.
That's an excellent point.
So, what do we mean by becoming an activist? Well, the first thing we think, and we see smart folks doing this already, is finding opportunities that require deep engagement. You need to find opportunities where there's distinct improvement goals. If you can't find ways to make it better, it's going to be hard to create value.
Just to clarify, something David said I think is very important. It can't be stressed sufficiently, and that is when you look to buy a company and you make your offer based on the future opportunity, that value is built into the multiple. So for you then as an investor or as someone who manages or runs a portfolio company, for you to hit your targeted goals, you've got to take whatever was in that projection and assumptions in the business model, and you have to find ways to improve it further. That's the challenge.
The next thing is embracing the undermanaged. I think I said it earlier that the fundamental premise that private equity investors hold sacrosanct is the view that they invest in good management teams. Therefore, it's a litmus test they use, and if somebody doesn't have a great management team, they don't want to do the deal. Well, and by the way, it's particularly true as you start moving down in the market. There's no such thing as a perfectly great management team. Everybody needs help. The smaller you get, the more help is needed. So it's good to learn to embrace and accept the undermanaged. The reason you don't want the undermanaged, the reason you want a perfect management team is you don't want to get involved. Well, we've already passed that bridge. We think you do need to get involved, and therefore you want to embrace and accept the concept of looking at the undermanaged opportunity. And as I say, the best managed companies are going to need more help and can use it. And by the way, if you can't help, if you don't think you can add value, if you don't see opportunities to make things better because you see certain things that can be done to that company to change it over and above the management's plan, and if you don't see ways to make management better, take a pass on the deal because there's probably somebody lined up to overpay for it. And, oh, by the way, what doesn't count as help? Everybody has the same mantra. We help you recruit. We help you find partners. We have great relationships to get you financing. We can help you do acquisitions. Fabulous. Everybody does that. Everybody says it. It's not really something you can count on as a distinctive competence. The fact of the matter is you've got to roll up your sleeves to do work. The second thing is you need to develop plans that are really tailored to this active investment thesis. If we're going to go after businesses where we think we can add value and change them over and above the plan that management already has, we've got to do due diligence with true operational depth. And boy, I agree with Jeff completely. Due diligence is a real shortcoming. Jeff and I have been involved in companies where due diligence was done, and 2 months into it, out of the chute, stuff had been missed and the company was in trouble. People rely on accounting firm quality of earnings. I've seen quality of earnings report, Sarbanes-Oxley compliant financials that were completely garbage with respect to the product profitability, state of the inventory, and what the true economics of the business were. And you have got to roll up your sleeves, and everybody's got to sharpen up their game to get to a better level of depth.
And David, just to add on to that, from a legal perspective, too often in an M&A deals, the person or people that do the due diligence are the young associates. And so
right.
Even from the legal standpoint, perhaps recognition needs to be given to the importance of due diligence and staffing it both from an advisory perspective and from a fund perspective that recognizes that it isn't only the legal documents, it isn't only the numbers, It's the operational, it's the gestalt, it's the entire business.
And I would say it's also true that the focus on the financial due diligence side of it is often accounting oriented, and that's great. That's dandy. You need that. But you need to go to the operational side of understanding operationally and profitability wise what's happening. The next thing, and this is really important, one of the tests for you is you want to find out where it breaks. If it all looks good, keep going down to the level where you find out they can't explain the business, they can't explain their margins of performance, because now you're getting down to the level of finding out where the issues are. And then you need a plan that goes way beyond the typical 100-day plan with specific project identification. Not just milestones of what you're going to get done, but what's going to happen, but what you're going to do. And then follow up relentlessly. Usually the 100-day execution plan is filed and it's reported on in the board meetings. If I closed a deal, I'd want to be talking to the CEO about it, and in fact, his next layer down, we'll get to that in a minute, the next week. And then keep a constantly replenished set of projects. When you're through that set, get yourself another set of projects to do. The third part, and this is really important, and people pay lip service to it, but it doesn't really happen. You need to establish a shared belief in your direct involvement with management up front to improve results. One of the hardest things to do is to come in and engage with a company that needs help or trouble, whether there's a problem or there's an opportunity later on. That management teams can resent involvement, and you feel like a foreign body, an irritant coming in to be engaged. Well, part of that's because, remember, up front, we made a promise to them that we wouldn't get involved in their business. We'd leave them alone, and that's a complete, false promise. You need to develop that engagement and belief up front with management so that you can get them to accept you in right up front, and you want to set that right up front in the process. The last thing is, and I think we've talked about this, we don't need to go through it as much, but you really want to bring experienced people on your team. And one of the issues is this what I'll call the problem in the middle issue, which is you've got these experienced partners, but who have experience in finance and legal issues, and Excel Ninja on one side. You need some people in the middle with good industry skills or good analytical skills to be able to solve problems. They've got to be able to dive deep and come up to speed quickly. It's more important that they can come in and get answers to questions and figure stuff out than they have industry knowledge. They've got to be able to speak discrepancy data, deal with detailed data information, and to be able to dive into the accounting systems at a level at which most firms don't have those kinds of skills. And then the last thing is, there's no substitute for spending time on site. Being there frequently, much more frequently. It doesn't mean quarterly. Whether you're on site or you're engaged telephonically is less important, but you need to reach out and touch people to keep action and progress, keep focus on those performance improvement projects that have been identified, and very important, as a litmus test, make sure that you have the ability and are engaging below the CEO level. That's the sign of a CEO who wants help and is willing to take help and work on his business by the fact that he or she gives you access to the next layer of people down. If you don't have that, that's a sign that you're not getting engaged. And then be ready to jump in with all the resources that are needed and get there right away. Don't wait to tackle problems.
Thank you, David. We want to wrap this up by suggesting strategies, specific steps that private equity funds and management and investors in private equity portfolio companies can implement based on what we've talked about and what we've seen. As the slide suggests, the first part is incorporate the recommendations in terms of active investing. As a lawyer, you would never recommend your company fund a deal without having the documents that memorialize the agreement. So too, I don't believe that you should conclude your negotiations without immediately engaging in the concept of not me versus you, or not passive, but collectively the investor and the portfolio company can do some very special things when they work together. Number 2 is hire and develop personnel with operational and financial acumen. I can't tell you how important it is that you build your teams that have the ability to look beyond just the numbers. Certainly, a number of funds have hired operational people that have been involved in companies that have been successful. That doesn't necessarily mean you have operational expertise. So it's very important that you hire and develop the proper personnel. The third is, along the lines David discussed, establish a 90-day to 100-day post-investment execution plan. Don't just rely on the targets, but look for projects, because that involvement and that interaction hopefully will both help you get the target and align the parties, and in addition will help you address issues that come up along the way. Along those lines, create a fire department staff for underperforming investments. And I don't mean here failed investments. I mean investments that may have a certain target that's not being reached. Understand why. Drill down. It's invaluable that you do that, and certainly at the earliest possible opportunity. And lastly is continue to challenge your model and assumptions. As I said, it seems so obvious that active investors actively invest. But the reality is, when you, in this market, to get a deal, when you align yourself with management by saying, I'm going to stay out of your way and let you do your job, you're not bringing to the opportunity skills and abilities that you as a private equity fund have that can enhance the opportunity. I will leave you with a story that one of the things that I recommend to my clients, especially early stage and startups, is a concept I call not all money tastes the same. By that, what I mean is, certainly you want, when you're going to raise money from the portfolio company, from the target company, you want a certain amount of funds to develop your opportunity. And I advise them that look past just the money. One particular deal I worked on, we had a significant investment that was needed, and there were multiple options. We chose someone who happens to be the third largest shareholder of a Fortune 50 company. It was the same dollar amount, the same term sheet. The difference is 1 month later, we're before that company with 5 new deal opportunities and introductions that were more valuable than the money we received. So again, one of the challenges that we'd like to suggest and leave you with is it's a great market. It's an exciting market. It's an exciting opportunity. But there are challenges, and there are structural and there are non-structural challenges that we've tried to address. Make sure that as you approach your deal opportunities, your portfolio, your investing strategies, that you don't simply accept if it's not broken, don't fix it, but rather actively look to fix something so that it isn't broken.
That's right.
Any event.
And by the way, as you see, funds are starting to do this. The smart ones, the good ones, are embracing these principles. Absolutely.
David, we're out of time. I want to thank you for participating with me in this. It was really a lot of fun. I want to thank everyone for joining us, and certainly feel free to send us any questions, comments, and we'll be happy to get back to you. Thank you again.